You've probably seen the headlines. OpenAI has launched GPT-5, its most powerful model yet. Microsoft, Meta, Google, Amazon all are spending record amounts on AI. Stock prices in the tech sector are on fire, and yet behind all this excitement, there is a risk that nobody is talking about. What if the AI acceleration is already starting to slow down, but the money pouring into it is still going vertical? That is the perfect recipe for a market bubble, and history tells us that bubbles don't end quietly. If this pops, it could hit Indian markets in ways that we are not expecting. Let's break it down. But first, make sure you like the video and subscribe to the channel. When GPT-4 came out last year, it felt like a revolution. Suddenly, AI could write code, pass exams, summarize documents, even mimic creative work. So people started asking, is artificial general intelligence or AGI just around the corner? Now GPT-5 is here. It is genuinely more capable, better at reasoning, coding, understanding complex tasks, and video, audio, text. It can work with multiple modes across the same model. But here's the reality check. Even its creators admit that this is not AGI. The jump from GPT-4 to GPT-5 is significant but not earth-shattering. And many of the biggest productivity gains are already behind us. Now, that is not a failure, it's just how technology S curves work. Growth is rapid early on and then it naturally tapers. Think of smartphones. From 2007 to 2015, we saw incredible leaps, but after that, the improvements have been incremental and minimal at best. But here's where things get dangerous. Even as the rate of AI capacity improvement slows, the money going into AI infrastructure is exploding. Analysts expect that by 2035, the total capital expenditure from just four companies, Alphabet, Amazon, Meta, and Microsoft, will reach $1.7 trillion. That is not total market size. That is just what they are spending on servers, chips, data centers, and network capacity. Now, to put that in perspective, that is more than the GDP of India in 2010 spent just to build AI infrastructure. And this spending is not a we will build as we go model, it is front loaded. The infrastructure has to be built now before the use cases and the cash flows are fully proven. Now, we've seen this before. The railway boom of 1800s, when tracks were laid across countries faster than demand materialized, the dot-com bubble, where telecom companies buried millions of kilometers of fiber optic cable that went unused for years, even the US housing bubble, where supply ballooned ahead of sustainable demand. In each of these cases, when the expected returns did not arrive fast enough, the market corrected brutally. Now, one of the more telling signs today is Meta's financing strategy. Even though Meta is hugely profitable, it is now putting together a $29 billion financing package for AI data centers, including $26 billion in debt from private credit firms like PIMCO, KKR, and Apollo. Now, think about that. When big tech starts borrowing from private credit, which is the shadow banking sector, instead of just using their own cash or issuing cheap corporate bonds, it's a sign that they are stretching. Not because they are broke, but because the scale of investment needed is beyond even their own staggering cash flows. Private credit markets are happy to oblige right now, but if rates spike or sentiment turns, that debt becomes an anchor. So the obvious question is, what could pop this bubble? Now, scenario 1 is that the economic ROI from AI simply takes too long. Companies will pour billions into building AI products, but the revenue does not match the hype, at least not fast enough to justify the investment. Scenario 2, the cost of financing explodes. Remember, the capex wave is happening at a time when global interest rates are still elevated and the private credit market can be fickle. Scenario 3 is regulation or geopolitics. US export bans on AI chips to China, EU privacy laws, or India's own data localization rules. These can all add friction to AI deployment. And scenario 4 is investor rotation. If mega cap tech earning growth plateaus, funds could start flowing into other sectors, and these AI linked valuations can unravel quickly. Now let's talk about India, because this is not just an American story. Our IT services giants are all positioning themselves as AI integration partners for global clients. That means they stand to benefit while AI investments are flowing. But if the global AI build out slows, the pipeline of big transformation deals can shrink fast. Remember, over 60% of Indian IT revenue comes from the US. If American big tech starts tightening budgets, Indian IT feels it almost immediately. Then there is the startup ecosystem. Right now, AI startup is the fastest way to get a meeting with a VC. But much of that capital is coming from global funds chasing AI opportunities worldwide. If the AI sentiment sours in the US, that funding spigot can shut for Indian AI startups no matter how good their tech is. And finally, the markets. Indian equities have been a beneficiary of massive FII inflows over the past 2 years. If there is a global tech correction, that risk on capital can reverse overnight. In a risk off environment, FIIs sell emerging market assets first, not last. And that can weaken the rupee, raise import costs, and put pressure on sectors like energy, autos, and even consumer durables. So, how should you position yourself as an investor? First, don't chase AI linked stocks blindly. Hype is not a substitute for earning. Second, keep an eye on big tech financing. If you see private credit deals drying up, that's an early warning signal. Third, treat any big correction as an opportunity to buy quality Indian IT names at lower valuations, but be selective. And finally, remember that every technological revolution over the last 200 years has gone through periods of overinvestment, correction, and consolidation. And the survivors from that shakeout often deliver the biggest returns. We are in the middle of one of those overinvestment phases right now. Whether the correction comes in a year or in 5 years, history suggests that it will come. The smart investor is not the one who predicts the exact month, it is the one who prepares for the day when the narrative flips. And when it does, you will want to be holding cash, not conviction. Now, if you found this useful, hit subscribe, share the video, and join my Telegram group where we discuss global market moves and what they mean for your portfolio every week. The link is in the description.